All right, so let's unpack this. We are diving deep into the fiscal fourth quarter and full year 2025 results for Birkenstock. They dropped pre-market on December 18th.
And this is one of those classic, almost painful scenarios, isn't it?
It really is. The company operationally just crushed the quarter, but the market reacted as if the whole thesis was broken. The stock just got hammered.
It's a classic beat and punish. Management made a choice, a very deliberate choice, for brand scarcity and what they call democratic pricing instead of protecting margins from macro hits.
And the market, well, the market absolutely hated that choice.
Exactly. So our mission today is to look at those strong headline numbers and then figure out why that forward guidance, that bridge guidance, caused so much pain.
That's the key, right? The bridge guidance. What was in that gap between now and when all their big capital investments finally pay off? But, before we get to the fear, we have to start with the facts.
We do, because on paper, fiscal 2025 was, it was a spectacular year.
Just spectacular.
If you look at the fourth quarter numbers alone, revenue hit $526 million. That's growth of 20% in constant currency.
Which was a really clear beat against what everyone was expecting.
A clear beat. And the profitability was just as strong. Adjusted EPS for Q4 came in at 0.51.
And the consensus was what, 0.40?
0.40, so it just flew past that. But really the full year picture is what management wanted everyone to focus on.
Right.
For the full year 2025, total revenue hit $2.1 billion. That's 18% growth in constant currency, and it blew past their initial guidance.
And the profit engine was just roaring. Adjusted EBITDA margin for the whole year hit 31.8%.
That's a 100 basis point improvement year over year, right at the high end of their term.
So strong.
And for brand people, the health metrics were just phenomenal. They sold over 38 million pairs. That's up 12% from the year before.
While keeping over 90% full price realization, that's the holy grail, right?
It is. When you have high growth and high full price sales, it just screams that demand is way, way bigger than supply. Plus, they rapidly deleverage their debt down to a very healthy 1.5 times.
So, okay, we have record revenue, record margins, massive brand integrity, and they're paying down debt. Yet the stock just plummeted.
And that disconnect is what we're focused on. It tells you the problem wasn't in the rearview mirror. It was all about what's through the windshield.
Absolutely. The forward-looking pain is all rooted in their operational reality.
Which brings us to our first deep dive. Operational resilience and this idea of engineered scarcity. Management was crystal clear on this. Demand is, quote, very strong. It's unconstrained.
So any limitation is entirely self-imposed.
Entirely. The company is basically telling the world we are throttling our own growth on purpose to keep distribution disciplined.
Okay, so how does that work, this engineered distribution? And why prioritize scarcity over just, selling as many shoes as possible right now?
Well, it's a very strategic choice, and it's getting more complicated because of their big push into premiumization.
The product mix shift.
Right. We saw the share of their closed-toe revenue jump by 500 basis points year over year. It's 38% of the business now.
And those products have a higher price, a higher ASP, but they also create a headache on the factory floor.
A huge headache. I mean, management pointed out that a single Boston clog, which is turning 50 next year, by the way.
Amazing.
It takes more than double the production minutes of an average sandal.
Wow. Okay, so a 50-year-old product is now one of their hottest items, and it's also the core bottleneck in their entire system.
Exactly. And the fact that new closed-toe styles like this new wrap silhouette are seeing triple-digit growth just confirms that demand for these more complex items is exploding.
So let's talk about the channel mix then, because that's just as complex. B2B, so wholesale, actually outpaced their direct-to-consumer, their DTC growth.
Yeah, 21% constant currency growth for wholesale versus just 12% for DTC.
Now, I get the positive spin, but let's be critical for a second. Isn't relying on wholesale for your high margin growth, isn't that fundamentally riskier for a premium brand? You're sort of giving up that direct customer relationship.
It's a valid question. Management spins it by saying this strength in B2B is from younger, first-time customers finding the brand in these curated multi-brand stores. And since wholesale has the highest EBITDA margin,
they argue it supports profitability, especially when your production capacity is so tight.
Right. But you pointed out the mathematical pressure. We heard the analysis that to get the same financial impact, you have to sell roughly 2.4 pairs in wholesale for every 1 pair you sell online.
So if your factory is already squeezed making these complex clogs, and then you have to make even more of them to satisfy wholesale demand, That's a huge strain.
It all funnels back to that core strategic constraint. Growth is capped by production capacity and this deliberate choice to maintain scarcity.
And they put a number on it.
They did. Unit growth of only about 10% per year. That's the plan for the foreseeable future. That is their hard ceiling for now.
And they are trying to raise that ceiling, but it just takes time. They announced, 110 to 130 million in CapEx, new assembly lines near Dresden, pre-production in Portugal.
But the market is smart. It knows these investments won't really solve the bottlenecks or expand that 10% unit cap until fiscal year 2027.
So they're investing for the long term, but the market is reacting to this immediate 2-year gap.
Which brings us to deep dive 2, the FY26 guidance reset. If capacity is the main constraint, the financial guidance is where that constraint plus some external factors became really painful.
Yeah, this is the undisputed cause of the sell-off.
No question. The first warning sign was the growth outlook. FY26 guidance is for constant currency revenue growth of 13-15%.
Which is a noticeable slowdown from the 18% they just posted.
It is. It suggests they're tapping the brakes because of those capacity constraints we just talked about.
But the real shock, the thing that just hit like a ton of bricks, was the macro tax on their margins.
This is the part you really have to pay attention to. Management basically baked into massive external headwinds that are going to crush profitability in 2026.
And let's be clear on the scale. When we say basis points or BPS, we mean 1/100%. And they cited 2 separate 100 BPS hits.
First, FX. The currency headwind. They're expecting a 100 basis point drag on both gross margin and adjusted EBITDA margin for the whole year.
And they said it'll be worse in the first half of the year, Q1 and Q2.
Right. And second, the incremental tariff headwind. This is about EU-made goods coming into the U.S. This is an additional 100 basis point drag on both of those margins.
Wait, so just to be clear, these 2 external things, they can't control FX and tariffs?
Yeah.
They add up to a 200 basis point drag on EBITDA margin.
A massive 200 basis point drag. Yeah.
That's significant. That completely wipes out the 100 basis point improvement they just made, and then it takes another 100 on top of that.
It is the definition of a macro tax.
And the resulting margin guidance confirms it. FY26 gross margin guidance is now 57.0, 57.5%. That's way down from the 59.1% they just did.
And adjusted EBITDA margin is guided to 30.0, 30.5%, down from 31.8%.
So this is a perfect example of great operational execution getting just undone by macro stuff that's completely out of their control.
It is, but the way they decided to handle it, especially on pricing, that gives you a critical insight into their long-term strategy.
Yeah, the CFO gave this fascinating little window into their pricing dilemma with the tariffs. He basically explained why they were willing to just absorb the margin hit.
They're choosing dollar-neutral pricing over margin-neutral pricing.
So explain that.
Okay, think of it like this. A shoe costs you $100, and you make $60 in gross profit. That's a 60% margin. Then a new $10 tariff gets added.
Right.
If they wanted to keep that 60% margin, they'd have to raise the price by $25, which is 2.5 times the tariff itself.
And they said that was unacceptable for what they call a democratic brand.
Exactly. They see that as just too much of a price hike for their customer. So they're willing to sacrifice their short-term margin purity to keep the price accessible and protect the brand's value.
Which is admirable from a brand perspective, but it's exactly what spooked the short-term focused market.
Absolutely. And this guidance really confirmed a lot of pre-call worries for investors. The U.S. tariffs, the FX headwinds, and this sensitivity to B2B growing faster than DTC.
But there's a clear long-term growth story here that could be a defense against this margin pressure.
And that's the APAC region.
The Asia Pacific.
Yeah. Right now, it's only 11% of their global revenue, but it's growing at a blistering 34% in constant currency.
And crucially, it has the highest average selling price in the world. Management's long-term goal is a third of their business in the Americas, a third in Europe, and a third in APAC.
Which tells you the Asia story is just getting started. It's a huge, high-margin white space for them.
And even with the tough margin outlook, they signaled they're healthy by confirming a $200 million share repurchase for FY26.
That's a strong signal, right? A commitment to capital returns even when things are tough.
So all of this led to some disagreement among analysts. Bernstein flagged some concern about B2B acceleration, wondering if it meant brand momentum was slowing.
But then you have Telsey, who reiterated their outperform rating, betting on that long-term scarcity story.
So the near-term takeaway for the whole premium consumer space seems to be that the debate has shifted.
It's not just about sell-through anymore. I mean, it's clearly fine here. It's now about whether these premium brands can protect their gross margins from these big, persistent macro hits like tariffs and currency swings.
All right, let's shift gears completely. We're going to step onto the trading floor for our This Is Not Financial Advice segment. We're pitching an outrageous but plausible trade idea to an investment committee.
Okay, I'm ready. Cue the sound of money printing.
Here is the pitch. Long scarcity, short cyclicals.
I'm intrigued. The market is definitely treating them like a cyclical stock right now.
That's the observation. The market's 11% sell-off is an emotional reaction to these external temporary macro costs, the tariffs, the FX. It's treating Birkenstock like a standard consumer company whose demand is shaky.
But the demand story is pristine.
It's pristine, so it's pricing in margin compression that is externally driven, not demand-driven.
Okay, that's the narrative. So what's the investment thesis that goes against that?
The thesis is that this is fundamentally a scarcity brand. It has proven unconstrained demand, a unique self-imposed unit growth ceiling of around 10%, and crazy high full price realization. The brand is healthy.
So the headwinds are locked in for 2026. Where's the catalyst? What turns this around faster than the market thinks?
The trade is long Birkenstock, betting on one thing, geographic diversification. You bet that the high ASP, high growth APAC white space, which, and this is key, has lower tariff and FX exposure, you bet that it accelerates even faster than expected.
So you think management is being conservative with their APAC growth targets?
I think the demand there could surprise to the upside, providing the geographic margin defense that the market currently doubts exists.
So you're calling the tariff tax temporary, and you're betting that the combination of the product mix shift to closed toe and the APAC expansion just overwhelms that tax within the next 12 to 18 months.
And that makes the current 11% discount look irrational. We buy the demand story, we buy the scarcity story, and we short the emotional reaction to this guidance bridge. It's a bet on premiumization overcoming transient macro pain.
That is compelling. Okay, to wrap up, let's leave you, the listener, with one final provocative thought.
We've established that production capacity is the only real constraint on their growth. And the most profitable products, the clogs, take up the most production time. So what happens to their profitability if this strategic shift into high production minute clogs and the high margin wholesale channel keeps accelerating?
Is the company's tight 10% unit cap the smartest long-term play to ensure scarcity and pricing power? Or is it an unavoidable tax on explosive demand that actually limits how big this brand can ultimately get? Something to think about as you watch their expansion plans unfold.
So to recap the core message, Q4 was a strong operational beat across the board, but that FY26 guidance introduced some serious macro complexity tariffs and FX, which reset near-term margin expectations and led directly to all this volatility.
And as always, please remember that everything we talked about here is for informational and analysis purposes only. We are just synthesizing facts and framing potential outcomes.
We are absolutely not giving you investment advice. Until the next deep dive, stay informed.